let's talk about dollar yen. This has been on our watch list since forever. Week before last close, there's a huge low test bar. Last week, I took out the high of this low test bar, so it looks pretty bullish on the daily. And well, finally, it's busted out of this downward trend, and you could say, well, actually, it's ready to go long based on this. Is it ready to continue its surge to the upside, dollar yen? Well, as we talked about in the trade idea, this choppy range here coincides with the 50% Fibonacci retracement from the very start of this trend, all the way up, down. But how are we going to hop onto this one? Well, let's have a look at other yen-based pairs, like the Singapore dollar versus the yen. There we go. Here we go. This is slightly better because that hasn't run already. This is on the weekly time frame. And if, for example, we did look to go long on this, it's very similar to going long on dollar yen, except it's lagging behind slightly, which is fine. Okay, so here's an idea for you for Singapore yen. What we can do is, based on the fact that we have an outside bar, bullish pin bar reversal, closing last week, which has taken out the high and the low of the last 1, 2, 3, 4, 5, 6, 7, 8 weeks. That's quite significant. It does look quite strong. We've also got, looking at this, bullish reversal divergence. Okay, so let me demonstrate this one. Bullish reversal divergence on the RSI is where we've got higher lows on the RSI. If we take a look at these lows here, getting higher and higher, but the lows here have been getting lower and lower. Okay, so that's a sign to us that actually we've got bulls creeping into the market surreptitiously. Okay, and we are looking at yen weakness because Japan is screwed, basically. And I will tell you why. They've got an inverted population pyramid. The balance of payments is not good. Their interest rate is basically through the floor. They're not going anywhere anytime soon. And of course, any currency pegged to the Japanese yen is probably going to, by virtue of the fact their state of affairs is far better, fare better. So there we go. So just like with dollar yen, this is at the 50% Fibonacci retracement level from the very start of this trend upwards. It's retraced over the past year. Is it time to turn around? Well, all we can do is speculate, and the clues are here. So let me just recap. We've got last week closing as a bullish pin bar reversal. We've got bullish reversal divergence. So how are we going to play this? Well, what we can do is simply place an order above last week's high with a stop loss below last week's low here, giving us a nice difference between our entry and our stop loss. So if we're targeting the previous swing high all the way up here for a long-term trade, then we've got like 1, 2, 3, it's about 4 to 1 risking 1%, or an 8 to 1 risking 2%. With the conservative entry, that's fine. How are we doing for carry? Well, I can tell you the interest rate in Singapore is 0.1%, whereas in Japan it's 0. So if we're going long on the Singapore dollar versus the Japanese yen and essentially selling the Japanese yen, at least we've got something for the overnight carry. Not much, mere pence, but it's better than having that drained from our account every night. Okay, so just to recap, on the weekly we've got two options. What we can do is we can enter at the break of the high of last week, stop loss below the low, giving us a nice wide berth. That's the traditional way of trading long in anticipation of a move to the upside. The good thing about the entry above last week's high is that if we're only triggered into this trade if there's a clear breach of this 20 moving average, which has been respected, well, ever since last year, this time last year pretty much. Okay, price has been uniformly below it. So we're only triggered into that trade if we get a clear breach to the upside. Okay, so that could be one way of doing it. That's a safer option, and we're only in the trade if there is a clear breach and a decisive move to the upside, which is exactly where we're speculating the Singapore dollar versus the yen is actually going. Or you've got the other option, which you could prefer. Of course, there are risks. This is a higher risk one. It means doubling your reward to risk. And this is known as a 50 fib or advanced entry at the midpoint here, where we're relying on price going down or tracing, or things getting essentially worse before they get better. So relying on price coming down here to the midpoint before going back up again. Now, this one, of course, the good thing about this one is, like I mentioned, it doubles your reward to risk. That's absolutely fine. But the downside is, if we place our entry just at the midpoint here, it'll correlate as well towards the bottom of this kind of choppy range where price has fumbled along for the past, well, throughout summer. So based on this, there's a reasonably high chance we'll get filled at this bottom of this choppy range. That's absolutely fine. But that might not happen, okay? It could just surge off without us, without coming to fill us at our midpoint entry. Okay, so on one hand, you could go for the conservative entry at the break of last week and wait longer for less profit, essentially, if it goes the right way, or you could anticipate price retracing back this week, filling us at our midpoint, more aggressive entry, and and going up again afterwards. It's entirely up to you. It depends on what kind of trader you are. If, of course, you opt for the second option, there is, like I mentioned, the chance of price not going down next week and filling you and it going off without you. But also, on the same token, what could happen is price could go down next week, fill you, and just keep on going down, stopping you out at this point here, which is a very significant point last week. And this is, of course, if that happens, that's a trade which you wouldn't have been triggered in had you taken the standard safe entry at the break of last week's high. Okay, so there are pros and cons to whatever entry you take, and the decision, of course, is entirely yours.